Well, good afternoon, everyone, and welcome to our latest installment of Michigan First virtual series on credit awareness. My name is Brock Knoll, for those who don't know me. I'm the Assistant Vice President of Lending here at Michigan First, and we're excited to have all of you on for this important event. I hope everybody's staying warm in what has to be probably the worst winter that I can remember in a very long time. So, hope everybody had a safe holiday season. And now it's time to get back into the swing of things, and we're hoping to do that for you today. We're giving you some good tips. For those of you who have been members with us for a while, hopefully you've had the opportunity to attend one of our credit awareness seminars that we have in person. We typically do those once a year. In that event, we usually take quite a long time. It can be 2 to 3 hours, and we take a deep dive into what makes up a credit score and how to effectively manage your credit to ensure that when you do need to borrow some funds, you have the best chance to get the best rate that you can. This virtual installment of our quarterly webinar series on credit awareness and management will provide you with expert guidance on managing your credit score and its impact on your finances. This is going to be more of a quick hitter seminar, a little bit less information to digest than we do in our in-person seminars, but that's a good thing. We hope that it gives you a chance to leave with one or two things that you can take with you that immediately can help your credit score in the right now. And we have a treat for you all today. We're fortunate to have with us a person that I consider to be one of the leading experts in credit in the industry, and that's our underwriting manager for the credit union, Mr. Matt Martinez. Matt's been with the team for 2 years now here at Michigan First, but he's worked in the financial industry now for 20 years, mostly in the credit union space. So, ton of experience. He's an expert at educating not only our team, but many of our members on how to best manage their finances through credit and navigate through financial challenges to ensure that your cost of borrowing remains affordable for the long term. Before Matt gets started, I just wanted to say a few things of note. The chat feature within this presentations platform, that's going to be your opportunity to present questions to us. There's going to be no real-time audible questions. We have everyone muted and everyone's video disabled. So please direct messages in the chat to Jamie Baker or myself, Brock Knoll, with questions that you wish to have addressed at the end. And as always, if your question is too personal, you can feel free to stop by or give us a call after the seminar, and we can do that in a more one-on-one setting. The information presented today should last about 40 minutes or so, and then we're going to take those questions at the end. But we'll be out of here at 1. I know everybody's busy, and taking an hour out of your day certainly is appreciated by us. So without further ado, I'm going to hand this presentation over to Matt to begin. So thanks, Matt, and the floor is yours, sir.
Thank you very much, Brock. I appreciate that. And I want to thank all of you for being here today. I think we're all probably happy that this is one of our more quick hitter virtual installments because, like Brock said, it's pretty frigid and miserable out there. So I think we're all happy we're either in the comfort of our own home or in our own office, and don't have to be here at Michigan First. But thank you very much for being here. Just taking the time out to think about your credit and to try to improve that is no small feat. And no matter where we are in our credit journey, and it is a credit journey, um, and I kind of liken it to life. I mean, it kind of goes in the same vein, where there's ups and downs and peaks and valleys and ebbs and flows, and but no matter where you are in that journey, you chose to be here today, and you're choosing to try to help yourself in your credit, and that's amazing. We're happy to have you here and to be doing that. There are good times and bad times in life, and one of the times in our credit that we see where we see a dip can be the beginning of the year. And we do a lot of spending in November and December, and a lot of that is for the holidays, and a lot of that is rightfully so, or getting ready for winter. But we send us to see our balances on our credit cards go up and our score go down, and we want to kind of talk through that and so you have a better understanding of how to get out of that funk and get your credit in the right direction. So real quick housekeeping item that Brock noted, make sure that if you do have a question, you're putting it in the chat. But I do want to reiterate the fact that if you have more personal questions, we are here for you. Our FSRs are very good at kind of going through the financial exploration and making sure that you're on the right track for you and your family. And we here in lending really hone in on that credit piece and want to make sure that that's good for you. So if you do have something that is more personal, please set up a time with us to talk through that, and we'd be happy to kind of show you some of that and help you one-on-one with your own finances. But feel free to ask anything credit related, and we'll get to that. So let's kind of get into the meat of what we're going to talk about today. I think we all understand that if you want to have a good credit score, you got to make your payments on time. I think that's kind of ingrained in us and drilled into our heads. And it's probably the one thing that we all know about credit is you got to make your payments on time to have a good score. But I want to show you another thing, another driving factor of your credit score, and that is almost as big of a piece of that pie as the payment piece, and that's something that we call credit capacity. So credit capacity is the fastest path to a credit score increase. Now, I just mentioned the payments. If you miss a payment, if you have a 30-day late payment on your credit, you have to now make all your payments on time moving forward, and it's going to take you months and months to get that score back to what it was. You're going to see a drop in your score because of that. Now, we want to show you a way that you can get your score up very quickly and not have to wait months and months of doing the right thing. So we want to show you a way with credit capacity where you can make some improvements, make some changes today, and then next month you're going to see the fruits of that. You're going to see your score go up. So it's very quick. So what is credit capacity? If you were to look online, you would see something like credit capacity is the ratio of combined revolving credit balances in relation to combined credit limits, or the percentage of revolving credit available but not used. So in other words, all the limits on your open credit cards and lines of credits add up to $1 amount. How much of that dollar amount are you using? When it was first explained to me that in that first um, definition, the word available is kind of the key, right? We're looking for available credit. So it was explained to me early on in my credit, and when I was coming into the financial institutions by a man named Rex Johnson, that really the credit bureaus are looking for the available credit that you have to use. The credit bureaus don't know how much you make. They don't know how much you have in a savings account. So all they know is what they can see on the credit report. So what they're looking for is if something were major to happen in your life, if you were to lose a job or a major life event happens, do you have something that you can use if you don't have savings? So they're looking at that. What is your available credit? And I want to point your eyes on this screen to that piece of the pie down there. I talked about payments earlier. Payments are about 35% piece of the pie. So that's a big part of it, right? You have to make the payments on time, like I said. Credit capacity is 30%. That is just below the payment part of it. And so when you look at those two together, 35 and 30%, you have 65% of your score is tied up with payments and this idea of credit capacity. So if you can do those two things well, make your payments on time and have a good credit capacity score, you are going to be doing very well with your credit. You should see your score over a 700 in that instance. And now there's other factors, and we'll go through those in our other virtual credit installments, but we really want to focus on the credit capacity here. So kind of remember that how big of a piece of the pie that is and how big that can help you when you're moving forward. So first I want to talk about some of the loans that affect your capacity. Now these are unsecured revolving debt. So these are credit cards. If you have a Michigan First credit card, that would be involved in it. If you have another credit card or a bank one, but if you have those are all part of this. The unsecured line of credit is also a part of this too. The key part of that is unsecured. So anything that's a revolving line of credit. So these types of loans have credit limits that you can use. You can pay it down and you can reuse it again. So it's cyclical, it's revolving. You always have that limit and you can always use it as long as you're making your payments and paying it down. All right. So how do we calculate credit capacity? Now, the good thing to note here is if you have a nice app like Credit Karma or something of that nature, or if you ever go to annual credit report, or if you're doing your credit review with us here at Michigan First, It's right on your credit report. So you can see it calculates what your availability is or what your capacity is or what your utilization is. Those are the kind of the three words that it might be on your credit. But I also want to show you how you can do that on your own if you're not using one of those apps. And I'm going to use a kind of a round even figure here of $10,000. So let's say you add up all of your credit cards and they all add up to $10,000. And you spend a little bit on family for the holidays. Your grandkids, your kids, they deserve it. So you spent about $4,000 on them for the holidays. So now you have about 4,000 of balances across those credit cards. So that means your capacity is about $6,000 or 60%. That's the amount of available credit that you have to use. Now, we really want that to be around 70% or higher um, to really give you the best score. But in this scenario, we're using about 4,000 of that. So we have the 6,000 available to use. So why is this powerful? And I do think it is very powerful. And this screen really is a big part of that. It's really want you to think about this. Each percentage point of capacity approximates one credit score point. Now, that's not fully apples to apples, but it's pretty true, and it holds true across most credit reports. So think about that. In that last example where we had $10,000 of credit limits, and we only had the $4,000 balance. Let's say we had to get a new furnace, and we spent way more than we thought we would on the holidays. And now we're up at $10,000 balance on all those cards. In that scenario where you have a $10,000 balance and you are maxed out, you are giving up 100 points. So that might be the difference between a 615 score and a 715 score. That might be the difference between 5% of interest, which could be thousands and thousands of dollars over the life of your loan. So just based on that right there, you could be losing not only your credit score, but losing money over the life of your loans when you're taking out loans. So are you maxed out on your credit cards? If you are, I want you to understand that you are not alone. There are a lot of people that are maxed out on their credit cards right now. And in this country, in America, we are seeing some of the highest credit card balances we've ever seen before. So if you're in that boat, you're not alone, but you do have a great opportunity to boost your score. So I'm going to kind of go through that a little bit and show you some of the ways that we can do that. Now, why did my score go down? We kind of talked about that a little bit before. November, December, the holidays, you're getting ready for winter. There's bills there's things that come up. And with inflation being the way it is, with the economy being the way it is, we might be leaning more on our credit cards than we normally would. So how do we gain credit capacity? Well, a first way we can do that is open a credit card with Michigan First. Shameless plug, but not really shameless. It's a very good way to get a very quick capacity rebound. So basically, let's say you have one credit card and it's $3,000 and you're maxed out on that. So right now you have no capacity. You come to Michigan First, you say, hey, I want to open up a $3,000 credit card. We'll take a look at everything. We say, yes, let's give you a $3,000 credit card. So now we open that up. Now you have $6,000. You only have the $3,000 on your credit card right now. You've just given yourself about 50 points or 50% of that capacity back. That's huge. So it's a really good idea. Now, I do have a lot of members that come that say to me, hey, Matt, I don't really want another credit card. And I get that. But you do want the capacity boost. So if we're not paying down our debt, and we'll talk about that in a moment, opening a credit card is a very good way to do that. And you don't have to use the card. You can cut up the card, put it in a safe, literally put it on ice and don't use it. But it is a good way to get a nice bounce on your capacity. Another thing that we can do in this scenario, or in this case, to give us a credit capacity bounce back, is to pay down your revolving debt. Now, it's almost tax season, or kind of right in the middle or start of tax season, and some of us will have to pay the government at the end of taxes, but some of us get a refund. So you might take that refund and pay some of that down, pay some of your revolving down to give yourself a nice capacity boost. Or if you get a bonus this time of year, that might be another way to do it. Or if you have some savings, to do it that way. But paying down the revolving debt is obviously an easy way to get yourself a capacity boost. Another thing that we can look at doing is raising your revolving limits. We have a consultant that comes in through LSI a couple times a year, and one of the things she really stresses lately is calling every year to try to get a revolving limit increase on your credit cards. And this is so that you have the most borrowing capacity that you have, but also that you have the capacity that you need to get the best rate that you can going forward. So that is something that you can do. You can give us a call here on Michigan First. Say, hey, I've had your credit card for the last 5 years at $1,000. Can we try for $4,000? And we'll make that decision and we'll let you know. But I would do that with your other creditors as well. Now, the best way to do that is to kind of do both of those two things, right? So you want to try to pay down your revolving debt and raise your revolving limits. If you can do both of those two things at once, you're going to see a good increase in your score, and you're going to have a better borrowing capacity. But a couple things that I want to focus on are some of the things that we might see on our credit report that don't make sense, and what we need to do if we see that. So I want to talk a little bit about home equity lines of credit or HELOCs. And those are tied to your home. They can either be in first lien position or a second mortgage, but it's going to be tied to your home and it's going to be a mortgage essentially. And HELOCs are revolving, but they are not unsecured. So they should not go into your credit capacity. And we generally take these out for much bigger limits. So we're looking at doing big home improvements, maybe an addition, maybe a new kitchen that you've always wanted. And so we're usually going to take that money and we're going to spend it. Usually, we're not usually going to let that sit around. So if your HELOC is not reporting as a mortgage, if your HELOC is reporting as an unsecured loan and is going into your capacity ratio, then it's doing you a huge disservice and it's costing you a lot of points. So just think about that. If you have $5,000 in credit cards and you only have 2,000 on that or 2,500, you're at 50%. But now you add in a $200,000 fully maxed line of credit, that $2,500 is not 50% anymore. It's a very small amount and you're losing a lot of points. So you want to call your creditors, and if you see that, and we see it from time to time, and make sure that they report you correctly. Okay? That's a big thing that you want to do. Another thing you want to do is make sure your credit cards are reporting your limits. And I'm looking at you, American Express. I'm just going to throw it right out there. American Express, Discover, places like this are known to do this. And American Express is interesting because they tend to have higher credit limits. So you might have something like a $30,000 credit limit on your American Express, but you've only used 10,000 to date. So it's really only 33% of your capacity or so. However, if they don't report that limit, if they're not showing you that $30,000 limit, the credit bureau is going to calculate it at the $10,000 amount and it's going to think that you're maxed out. And that's going to hurt you because you're not getting that other $20,000 of available credit capacity. So you want to call them and make sure. And if they won't do it for you, you might want to, think about looking at different credit card options. But make sure you make that call and make sure that all that stuff is reporting the correct way. Another thing you can do, and we're going to talk about this at length in my next slide, is apply for a debt consolidation loan with Michigan First. The most common way that we look at these are unsecured loans, and it's a term loan, and we'll talk about this a little bit more. But another thing you can look at is using your auto as collateral, if that's free and clear, or the home equity line of credit. I talked about those as being used for a lot of times for home equity or for home renovations and home improvements, but a lot of times that's also done for consolidating debt. So all of these things have an end date. So you have a term on these, whereas the revolving credit is cyclical. So you don't have an end date on that. So we're going to kind of go through a little bit more of what that means as far as a debt consolidation loan and why to do a debt consolidation loan. So it gives you that quick capacity rebound that you were looking for, especially when the score is going down. And if installment loans don't affect capacity. So even if it's a revolving loan that's tied to collateral, it should not affect your capacity. So you're going to be able to pay this thing on a term, and you're going to have an end date in sight. And that's very important. Because I don't know if you've ever looked at your credit card bill, your credit card statement, and saw, and they kind of put it in the fine print now. They're made to do this, but they'll show you if you make your minimum payment. So let's say you have that $1,000 credit, you're maxed out. It's going to be about 20 or $25 a month, and you're going to make that payment, and it's not really going to touch much of your balance, right? You're going to pay the interest, then your interest is going to compound, and you're going to have that same payment next month. And if you only make that $25 payment, they show you it when you'll pay that off. And I did that once. I looked at all of my credit cards, and I will not be here when those get paid off if I were to pay those minimum payments only. So getting that to a term loan where you have an end date in sight is very helpful. Now, I plan to live at least a decent amount of time, but I really want to get this debt paid off so I'm not paying all that interest. So having that end date is a huge part of it. But I also want to stress this, and I want to take a moment here to really kind of step back and stress this part because I think it's very important. We want to be very patient and we want to make sure that we have our finances in order so we're not just charging the balances back up. Because we can bring you into Michigan First, sit you down and say, hey, you got $10,000 in credit card debt. Let's give you a $10,000 term loan and then get you on your way, right? And great, everyone's happy. But if we haven't kind of looked at, some of the root causes of why you were spending the money, you might just go right back to that. And that's what we don't want to have happen because we don't want you to get to that end date where you have done the right thing and paid down all of your debt and done it in a more responsible way, but at the same time, you were just charging those credit cards back up because you're really doing yourself a disservice and you're kind of going to go right back into that same thing. And that becomes a cyclical thing where you're always just having to do another debt consolidation loan. And we want to get you into that point where you're not having to use the credit card. So we really want you to sit down with one of our FSRs, our financial services representatives, really kind of go through your finances and really make sure that we're putting you in the best position to both pay down a new loan and not charge back up the old ones. The shorter the term, the better. So the shorter term on an installment loan when we're doing your debt consolidation loan, the better. And so this is especially possible if you pay more than your minimum payments on your credit cards today. That might make sense for you to do a higher payment, shorter term. And I'm going to kind of go over what that looks like in a moment. And it might make sense even if your monthly payment goes up. So if your monthly payment's only the $25 on that $1,000, and let's say you have 10 of those, and so your monthly payment's really only $250 on those 10 loans, on those 10 credit cards. If your monthly payment's going up to $400, yes, you're paying more on a monthly basis, but you're going to pay that off quicker, and that might make a lot more sense for you and for your borrowing. So I want to kind of really dive into that a little bit more and really show you a couple different debt consolidation examples, things to really consider. So let's say in that when we were talking about earlier the $10,000 limit and you had a $4,000 balance, and we're kind of showing you what the capacity is. Let's say you really like everybody had a good holiday season, and you get a gift, and you get a gift, and everybody gets all the gifts. You were feeling really good about the holidays, and you spent $10,000, and now you're coming to Michigan First, and you want to do a $10,000 debt consolidation loan. So what we're going to do is look at that from an unsecured perspective, and I want you to know that both these two examples have the same balance, $10,000, and the same interest rate, 14.99%. So let's dive into example one first, this first option. You have a balance, you're coming in for $10,000, and let's say you take that term out for 5 years or 60 months. Okay, your payment on that is going to be about $237.75 per month. But over those 5 years, if you make every single payment on time, and if you make all of your payments for the 5 years, you will have paid in interest $4,264.30. Now, that means over those 5 years, you're going to pay back $14,264.30 on that $10,000. Now, this is still an immensely better option than just paying those minimum payments because you will pay much more interest over that life of that loan. And when I mean much, it'll be a lot more interest that you'll be paying. But so it's still a better option, but I want to show you a different way of looking at that. So if we look at loan number two here, again, same balance, $10,000, same interest rate, 14.99%. But on this one, we're only doing a 24-month term. That's only 2 years instead of the 5 years. So we're already, kind of mentioned this earlier, shorter the term, the better. And here's why. The monthly payment, yes, will be higher. It's going to be 484.55. But if you look at that interest paid, if you pay this loan over the 24 months, every time on time, you pay it the same way, you pay it off on the term, you only have paid $1,629.12 of interest, or over the life of that 2 years, $11,629.12. So what does that mean? That means in loan two, your difference in payment is almost $250. So you will be paying $246.80 more in the second option than in the first option. So can you afford the higher payment? If you can, it might make sense because if you look at the difference in interest paid, it's $2,635.18. That's how much less interest you will pay if you pay it over 2 years as opposed to the 5 years. So our job in this scenario, especially when we're kind of looking on the front line from a financial services perspective, we want to give you the tools and the idea and the options, but you need to make sure it makes sense for you and your situation and for your family. So does it make more sense to make a higher payment and pay less interest? Or do you kind of need that monthly payment relief and you're willing to pay the more interest because you are paying less by making it into a term loan? So what is more important to you? We can also look at these in different installment lengths, 2 years, 3 years, somewhere in between there, 30 months, 42 months. We can look at all the different options and kind of see what the best is for you and your family, and you make that determination, and then we'll go from there. And we don't close down any of the credit lines. I've been at other institutions where we would send out closeout letters and we would close that and take out um, some of some of the availability that you have. We don't do that here. So again, it's very important that you try not to charge those right back up. Now we all understand that things happen and we might need to use our credit at certain points. So I'm not saying that never use them, but try not to just go right back to using them for, all the time is what I'm saying there. So building better credit in 2026. How are we going to do that? We're going to get a capacity increase. How are we going to do that? We're going to do a debt consolidation loan. If that makes the most sense for our situation. And I also kind of want to mention here that we could include paying off some of your collections if you have collections, especially if they're newer, because it kind of does a double effect here. We're getting you the capacity increase, which is giving you a boost in your score, and we're paying off collections, which can also give you a boost in your score and can also help you just moving forward and getting better, being able to get credit a little bit easier by getting those things paid off. And again, adding a Michigan First Experience credit card. We have great rates, we have a great rewards program, and we have good limits. So let's talk about that. Let's see if this makes sense for you to get one of our credit cards in addition to one of our debt consolidation loans. And again, we want to really look at paying down those balances. Now, obviously, if you can do that outside of a debt consolidation loan and it makes sense for you and your family, then that's the best way to do it. You're not paying any interest in that route, and you're getting them paid down, and you're getting that boost in your capacity, and that's great. But if you can't do that, then I will point you right back to that debt consolidation loan, and we really want to, or adding in the Michigan First credit card. But I think it all kind of boils down to coming in and talking to one of us, talking to one of our representatives at Michigan First, and seeing what we see and seeing how we can help you and best give you that best advice on the best way to move forward with what you're looking to do for you and your family. So that is that. I really want to thank you all for being here, and for taking the time to listen to this. And I really want to know if there's any questions, but Really, come in and see us. We really do love educating our members. It's the Michigan First Way, and it's a big part of what we do. And we love talking to you and getting you on the right track. I love having it. When I was an FSR before I was in the lending team, I loved talking to our members and then kind of giving them some of those tools and tips and techniques, and then watching them come back to me 2, 3 years later when they're buying their first home with A+ credit and they're getting the best rate and they're thanking me. But really, it's all you. You are going to do the work. All we're going to do is give you some of the tools, and you're going to put in that work, and you're going to get yourself into a better financial situation, into a better credit scenario. So I'll stop talking now. Brock and Jamie, do we have any questions?
Thank you very much, Matt. And thanks everybody for taking the time to listen. Great job, Matt. That was a lot of great information packed into a short period of time. So if you have any questions, feel free to still put those in the chat. We do have a few questions here, so I'm going to lob these over to you, Matt, and let you answer these. First question that we had was, I went and opened up some store credit cards. Even though I was able to gain some capacity by doing that, why did my score go down?
So if you're talking about like an immediate drop in your score, so that could be a couple things. Anytime you get your credit pulled, your score can go down a little bit. And anytime you open a new debt, your score might go down a little bit. And it kind of seems counterproductive, but I think the way it is, what the credit bureau is looking at is how are you going to handle this debt? Are you just going to take out, if you got a Macy's card for $1,500, are you just going to max this out? Are you going to make the payments on it? So you kind of see a little dip in that, but as you continue going on, that, and really, like I said, it should be pretty quick where you kind of see the rebound on that, and that shouldn't affect you for too long.
Okay, thank you, Matt. And as a follow-up to that, do store credit cards count the same as bank credit cards?
Yeah, I mean, from a limit standpoint and a capacity standpoint, yes, they all go into that overall limit that you have, and then they are all the balances all add up and they show what your capacity is. I um but I would kind of have you look at that. I mean, there's reasons that people probably get the store cards. Maybe you get like a really good discount or 30% off. And so you want to get that discount on, like if you're going to, let's say you're going to JC Penney, you want to get, some khakis or something. I don't know. But you're going to get a discount on that. And then if you can pay that down, great. But the scorecards can tend to have higher balance or interest rates. So I would try not to use those as much as you would like a bank or a credit card one because we should have a better interest rate than that. So
All
that's
right,
that.
thank you, Matt.
You're welcome.
Um, Another question, is it smart to get a consolidation loan for the longer term, but pay it off quicker to still save on the interest?
Oh yeah, I mean you can do that. Uh I've when I was in the mortgage field, we would have people who would do like a 15-year or I'm sorry, a 30-year mortgage, but pay it like a 15-year mortgage. And that way, I think it's really smart because if one of the you or your spouse say loses a job and you can't make that bigger payment, then you still have that smaller payment to fall back on. So I do see that. But yes, anything that you make above and beyond that minimum payment that you have to make every month goes right towards the principal, and that cuts down on the interest that you have to pay. So that is a good option as well.
All right, next question for you, Matt. Is 14% the standard rate?
No, so the rate is derivative based on solely on your credit score. So no, that's not the standard rate. The rate is going to be whatever your credit score is, and then we have tiers. So if you have the best credit, you're going to get the best rate. If your credit's a little bit lower, the rate can be higher. So we do have the rates that are a little bit the higher or higher than that and a little bit lower than that. We kind of just use a rate that was more mid-tier. So no, but it is one of our rates.
And then I'll follow up on that quickly too, Matt.
Yeah.
That's the reason that we do these credit seminars to try to help our members get better credit scores because the better score you have, the better rate you're going to get. The better rate you're going to get, those examples that Matt went over, the lower payment you're going to have and the less interest that you're going to pay over the life of the loan. In that example that Matt showed you, if you shaved off 3 years on that loan and you saved yourself $2,000 in interest, just think about what you could do in your life with an extra $2,000. I think we could all take that right now. This all makes dollars and cents to your wallets and your purses. That's why we go over this. You want to get that best rate that's out there. One more follow-up question here, Matt, that I see is I don't use some of my credit cards, but I get annual fees on them. Should I close those cards?
Oh, that's a really good question. I'm of the mind that, I mean, me personally, I don't ever want to pay a fee, so I probably would never open up a credit card that would have a fee. But there might be a reason that you might be gaining something from that credit card and that fee. But I would tend to stay away from those because y- you're still spending that money. So you're and some of those fees can be high. They could be $199. Some of them can be 250. So you're gonna have to pay that off. So that's gonna kind of go into all of that. I don't necessarily you'd have to look at each one and see if you're getting anything for that fee. Because if you're not getting anything for that fee and you're just paying a fee just because, then I would not continue to pay that fee. I really wouldn't. But there might be, and I don't know what that is, but there might be a reason or something that would keep you to have that. But Brock, do you have anything else to add to that? Because that's a very good question.
Let me get myself off mute. And yes, yes, I do. That's one of those things, Matt, that you talked about earlier, that falls into the category of what's best for you. There are credit cards out there that charge fees. And like you said, you're getting something tangible out of that credit card, whether it's frequent flyer miles, whether you have a Disney rewards credit card,
Mhm.
and you get points for that, things of that nature. If it's really that beneficial to you and you want to pay the fee, pay the fee. The tougher situation is what this question represents is if you're not using the cards, do you want to pay the
Yeah.
fee? Like you said, I don't like paying fees for something that I'm not using. I would just say this. If the credit card is your oldest credit card, you probably want to leave it open because there is a portion of the credit that we didn't talk about today. That's a portion of the pie that is how far does your credit go back? And if you bring that time up by closing an old card, you can see a dip in your credit score. If those cards aren't your oldest credit cards and you do feel like closing them, I would just open up new cards to make up for the capacity that you're going to lose. So if you have a $5,000 credit card that you're not using that charges you a $100 annual fee and you don't want to pay that fee anymore and you close it, open up a new $5,000 credit card, preferably with us if you don't have one. And instead of losing that capacity, you're going to gain it right back. You still might see a little bit of a dip in your score for closing a line, but that's something that you can make up in a month or two, which to me would be worth not paying $100 a year for anymore. So it's a complicated question that doesn't have the right answer for every person. It's basically what you want to do. All
Thank you.
right.
Thank you.
Yeah. I don't think we have any more questions, Matt. So thank you.
I actually had one that was given to me.
All right.
Give me one
Go
second.
ahead.
It was a private message. Um, and so a member asked me when doing a debt consolidation, will that affect my score? And kind of we talked about this a little bit, but yes, you're paying down your credit, you're getting the capacity increase. So doing the credit pool and taking on the new loan might drop it a little bit, but the credit capacity bounce back that you're going to get is going to far outweigh that. So it can affect your score, but really these things, if we're paying off our credit cards and we're not recharging our cards back up, this really should help us. And it really should affect our score in a very positive way. So that is the first part of that. And then the member asked a question if they could do a credit score, a consolidation loan with um, a low 600 credit score. And I want to tell you right now, whatever that score is, don't that don't worry about the score. We don't look at score here. I mentioned score earlier. I mean, we do look at score because we want to make sure that we're being fair with everybody, but the score really drives the rate. And that's what we're looking at that for. When we're looking at a debt consolidation loan, we're looking at a variety of factors from a lending perspective. We're looking at how long have you had this debt? Is this brand new debt? What are the reasons for this new debt? We're looking at how you pay your bills. How do you pay your credit cards right now? How do you pay your mortgage? How do you pay your auto loans? We're looking at your the stability of your income. Are, are you at the same job for the last 20 years? What is your income level? How much unsecured debt do you have in relation to that income level? So there's so many factors that go into it. I don't want anyone out there to worry about what your score is right now when coming to talk to us about your financial situation. It doesn't, the score doesn't, that score doesn't matter. We want to look at your relationship with us as a member, and then all of those factors and more. There's a lot of factors that go into this. I kind of just mentioned a few of them, but really try not to focus on that. Let's focus on, yeah, if you have a 600 score right now, why? Well, how can we get that score up? What can we do? And if a debt consolidation is the way to help you really bounce that back and get you in a better financial situation, then that's what we're going to offer to you if it makes sense. So I wouldn't worry about that at all. We do lending for all borrowers and all types of credit. But that is the last question that I had.
All right. I would just like to hammer that point home that you just made, Matt.
Please.
We only look at credit score to determine what interest rate you're going to get on a loan. Okay. And that's it. And that's what separates Michigan First from just about every other financial institution in the area is that we are going to look at the full story. We don't care what your score is. We're here to help you get that higher so you get a better interest rate in the future. We look at more realistically what's going on. What's the story behind your current situation and why you need a loan? If it makes sense to us, and this is extremely important, if we feel that you're going to pay us back, we're going to make the loan for you. Okay. If we feel like you might have trouble paying us back, we're going to tell you why. And we're going to also let you know what you can do to get approved in the future. There's so many places out there, including all these fintech companies that are starting up that I've never even heard of before. Happy Lending. You see all the weird names out there. They don't care about you as a person. They care about charging the highest rate possible and giving you a loan in an easy manner so they can make more money off of you. We take the time to get to know you and try to help everyone we can. But if we can't, we are going to take that time to let you know what you can do. So don't be afraid to apply. The worst thing that's going to happen is you're going to leave out of here with some advice on how to help yourself in the future.
Mhm.
And that's that. And that's why I love Michigan First. That's why I've worked here for 17 years, is because I've worked at other places before this that did not do that. And I know several colleagues that I've worked with along the years that I've went to other banks and credit unions that miss what we did here at Michigan First. So we're here for you. Don't worry about your score. We're going to give you the best advice out there and try to help you no matter what your score is. All right, so it looks like we've addressed most of the questions. So some great questions today. Again, we appreciate everybody's time. If you have any additional questions, if you think of anything after this is over and you're like, oh man, I wish I would have asked that, or if it was too personal for this setting, come in and talk to one of our credit professionals. We have 32 branch locations now, if you can believe it. We have a virtual branch that you can call in and talk to. So come and see us, visit us, call us, whatever is the easiest for you, and we're going to be here for you. So, on behalf of nearly 500 team members now that we have at Michigan First, we want to thank everybody wholeheartedly for participating and supporting Michigan First Credit Union. Your membership means everything to us. It really does. But that's going to be it for now. I hope everybody stays warm. I know there's not an end in sight for the cold, but eventually it's going to be spring before we know it, and we're going to be doing another one of our seminars. So please feel free to join us again, even if it's going over some of the same information. It never hurts to talk about this a few times a year to keep yourself updated, remind you of a few things that you forgot. So hopefully we'll see you next time. Thank you so much for joining us, and have a great day, everybody.